Everybody to my first session. Anna asked me if I want to, and I'm happy to actually. One thing I want to ask you before we start is I think you don't have to, because we set it up the right way that all microphones are muted. Of course, you can use the chat, however, and that you try not to draw on the screen during the recording session. But I'm pretty sure we can handle that. The topics I want to talk about today are announced already in the web space. It's about market structure, it's CHoCH, the point of interest, imbalance, mitigation, liquidity, inducement, and order blocks. And that's a lot of stuff, I know, but those topics will not be covered in every detail. We cannot do this in 1 hour. We just recognize that we talk more and more about these topics in our internal sessions, or let's say in Telegram and also on the web space. And people get or come back with a lot of questions, what those phrases, let's call it that way, actually mean. And that is actually also the expectation for today. The expectation for today is that you get an idea what we are talking about. And it's not the idea that you will be an expert smart money concept trader after the session today, only that you have heard all the phrases at least once, and that you know what it's all about, actually. Not what it's all about, but what it's about, so that I'm pretty sure even after the session today, you have an idea what all of this means. And I'm also pretty sure if you are new to this, that you are very curious and want to know more about it, because we talk about these things for a reason. It's not that we just want to come up with new phrases. That's absolutely not what we want to do. It's the opposite, in fact, because we try to be very we try to not to come up with new phrases, in fact, because we don't want to confuse you. We want to keep everything as simple as possible. And we know whenever there's a new phrase, in the chat, it might raise questions, and that is very obvious, of course. And anything else I want to state for this one? Yeah, I'm also teaching other things. Well, actually, I'm not teaching trading so far, but I teach other things, and I'm always happy if we clear the expectations up front. What we want to reach with a session we have together, and I think this should be clear. This session should only be there to give you an idea about all the cool topics which are waiting for you. And I know there's a lot of traders also in Anna's group who already know those things and will maybe be disappointed because it's not covered in real details, but that's not what we want to do today. In fact, every single topic which we will cover today can be handled in several own sessions for several hours if you want to. But still, we sit back, we thought, how can we bring the topic to you for a first idea without further confusions. And if we manage to reach the target, is something you can tell us after the session. You just write it as a comment to the video, what you liked, what you did not like. We are very happy and open for any comments, and we want to improve with you together, of course. Because there's a lot of things we have to learn as well. And please just write your questions in the chat. As far as I know, we can download them, and we would cover those questions most probably afterwards also in the web space, rather than in the session, maybe, because the session may otherwise take too long. I'm not sure if you can see it, but it's 50 slides roughly. And that means we have some topics in front of us. But now, enough waffling. Let's start with the first topic, which is market structure. Oh, so I see something should not be here. Market structure, yeah. When we talk about market structure, we talk about highs and lows, in fact. And you all know that the market has highs and lows, and it moves that way, to make it very simple. And we're not even at the moment talking about higher highs and higher lows. We just say, this is a high, this is a low, another high, another low, another high, another low, and so on. So this is the picture you usually get to see in trainings. And this is a, let's say, up-to-date picture from, I think it's the dollar. I just use it from the dollar this weekend. And you can see there's quite some similarities. Of course, this is always easy to teach, but it usually never looks that way. It's simple to explain, but people usually are very disappointed when they afterwards come to this one and see, well, it somehow looks like what we drew in together, what we talked about, but it's much harder to understand, and I can fully understand this topic. If you're new to this topic, it's not as easy as everybody wants to claim, say it that way. But this will become better with chart time, as 𝐂𝐤𝐿 calls it. The more chart time you have, the easier it will get. And now we not only have highs and lows, we have special kinds of highs and lows. I wrote them down here. You have higher highs, you have higher lows, you have lower highs, and you have lower lows. In this case, you have, let's say you have a high here. If it's a higher high or not, we cannot say, because we don't see the history on the left side. But we start here and suppose it's a higher high, it's a high for sure. And then you have a higher low. So this is a high, this is a low. And then the high is broken, hence you got a higher high. This high is higher than the previous high, hence it is a higher high. Then you get a new low, which is a higher low, because this low is higher than the previous low, so it's a higher low. And then you get a new higher high, because this high broke the previous high, or let's say it's just higher than the previous high. And then all of a sudden you get a lower low. Where does this come from? Because this low is lower than the previous low, and that's why it's called a lower low. And because this high, which is a new high, was not able to close higher than the previous high, it's a lower high. And then you get another lower low and a lower high. And what this means, I'm not saying it now because we will have additional slides, but I think you can already see from the color, you have a kind of, blue color for an uptrend, a red color for a downtrend. And yeah, this should indicate a little bit where we want to go. Now when it comes to market structure, we also talk about the boss, We have this in several sessions. What is a boss? And there is different kinds of bosses I will talk about, and I try not to really, I really try not to confuse you with the bosses. But of course, you have to have a main idea what it means, and it depends a little bit where you come from. Most of the traders I know, they call it a boss. But if you come from a similar kind of trading, then you might call it a BMS. And the boss is just short for break of structure. And the BMS is short for, oops, so sorry, 𝐂𝐤𝐿, I just clicked ask to unmute because I wanted to admit some people, but you did already, thank you. Where was I? Yeah, and the BMS is short for break of market structure, and both mean the same. It's just two different kinds of phrase it. And you can see here you have a high. In order to get the new higher high, the high has to close above, and at the same time you have a break of structure. And this, when I talk about the boss, I mean a break of swing structure, because this for me is a swing, and then you have a break of structure. And of course, this is now a, let's say, a very rough drawing. There's a lot of more things about it, and we will also talk about it. What more can we say about market structure? So, you know, we have highs, we have lows, we have higher highs, we have higher lows, and so on. And in SMC style, you would also have weak highs, weak lows, strong highs, and strong lows. And I actually like this concept because it gives you an idea where the price wants to go. Let's say you have a high here. At the moment, we don't know if it's a weak or strong high, but once this high is broken by a break of structure, you can consider that this was a weak high or is a weak high. And by considering that this is a weak high, because it was so weak that it could easily be broken, you suddenly get a strong low, which means this low can be somehow seen as protected. You know, it does not at all mean that the price cannot go below this low. That's not what it means. It just means the probability that this low is broken is lower due to the fact that it has broken the high now. So when you look for trades in this, if you want to frame it already, if you look for trades, you would actually rather look for trading bullish than bearish, because you have a strong low, which might be protected. And this continues the way up, in fact. So you have a weak high because it was broken again. You have a strong low. Then you have, suddenly you got a strong high. And the strong low you had before, which we considered protected. Why? Because it broke this high, was broken. And if you have a situation where you have a strong low, which was broken and suddenly becomes a weak low, then you can see or expect a change of market structure or a shift of market structure. Because you're not bullish anymore once this is broken from that point of view, and suddenly you start to get weak lows. And why? Because the lows now start to be broken. You get strong highs suddenly, because the lows are not able to break the highs, but the highs are able to break the lows. And it's always a kind of battle between the highs and lows. Who is winning against who? And in the uptrend, the low is winning against the highs because it always breaks them until a low is broken and the highs become strong. And then the highs start to win against the lows. So that's how you can see it if you want to. All right, so I think that's everything for this one. What do we have here? Yeah, that's actually the same thing as I already said. I just wanted to point out here again that you also might call the strong lows or high protected. Because of course, if you break a high, there is not let's say the interest of breaking the low is not very high. You want to move the price higher, and at some point you have to protect your orders, or the market makers are protecting the orders, and they just move the price higher. And if they break the low, the protected one, that's an indication for you that the price might change now. Not the price might change, I'm sorry, the market structure might change now. So we have also different swing structures, as you might have seen. And one thing you for sure have realized is that the price and the structure are fractal on different time frames, of course. That's what it means. And yeah, one thing you heard, of course, or for sure, is that the trend is your friend. And one thing which was quite new for me, but it's true, is until it ends, of course, because the trend ends at some point, and then a new trend starts, which is your new friend, until this one ends, which you can see here. Like you have a uptrend, which is your friend, until it ends and becomes a downtrend, and then the downtrend is your friend. And another saying, of course, is the structure is bullish until it's bearish. And I'm saying this quite often, and it's all, of course, also vice versa. I'm saying this quite often because if you have a bullish structure, you would probably not, unless you are a very experienced trader, you would not be looking for bearish trades. You would rather go for bullish trades. And sometimes it's actually quite obvious that the structure is still bullish, or most of the times, let's say it that way. And for me, I would not look for bearish trades, even if there is a high probability point of interest, order block, and so on. I would not, because for me, key is market structure, and I want to go with the trend until it ends, and then I go in the other direction. But that's, of course, completely up to you. What you can see here is you have the, let's say, the swing structure, and I don't want to confuse you with this. So if you don't want to forget it again, I just use this for my personal explanations, also sometimes to other people, to make it clear what's the main difference is. For me, the black line is the break of swing structure, and it's called the boss, the break of structure, because that's what it means to me, a break of swing structure. And then you have the internal structure, and this could be 4 hours and 15 minutes. And the internal structure, of course, you have, as we said, structure and price is fractal. You have also an own structure within the swing structure. And then there you also have a boss. So if you call this a boss and this a boss, it might get confusing. Of course, you can call this a 15M boss, a 4-hour boss, which makes it more obvious to you. But however you call it, you need to understand that this is a break of internal structure, and this is a break of swing structure, because this, for me, again, is a swing. And if the whole swing is broken, then you have a break of a swing structure. And if the internal structure is broken, then it's a break of internal structure. And again, you can call it boss, or you can call it whatever you want. I just use this to make it a little bit more obvious to you. And then we have a chart example. I think it's again the dollar from this week. Yeah, just wanted to use this one to show you again, to map out, like, you know, this is the 4-hour structure. And something I probably forgot to mention is that a low, for example, like this one, is only confirmed once you break the previous point, the previous swing point. So until, let's say it that way, until this high is not broken by this one, this low is not confirmed. The price could go much lower if it wants to, and then break the high, only then it will be a confirmed low in this case. So when and if it doesn't break the high, but it goes lower and doesn't break the high, it's internal structure until it breaks the previous low, and then you have a structure shift again. So everything, if you consider this as a swing structure, everything which happens within this structure here, this would be internal structure. But once the low is broken, you would confirm a new high, or if the high is broken, you would confirm a new low, like this one, as you can see here. And only then. So we have this 4-hour structure for the chart example, and then you have the internal structure, which looks a lot more messy, of course, and this is where most people struggle, and it's fully understandable. But you should really also focus on the main swing structure, because it's much easier in the beginning. Not concentrate on the 15-minute structure. You can see a lot of break of structures, a lot of break of internal structures here, but also breaking to the upside, breaking to the downside, and so on. And if we talk about break of structure, there is different considerations for different traders. Let's say, for example, a wick break versus a body break, and so on. And it really depends on your style of trading and how you learned your own way of seeing charts and reading charts, how you want to trade it. I think we will talk about that a little bit in a more detail later on. And then we already have the CHoCHs. I really tried not to talk about it before because you could see a lot of CHoCHs in the charts if you are used to see the CHoCHs. And what is a CHoCH? This phrase is, I would say it's rather new because, well, I'm in trading for 3 years now, and I only heard about it, let's say half a year since I'm in different groups. And I'm in different groups because, of course, I don't stop learning. I want to see what other traders do. And my main goal is to simplify everything for myself mainly, but then also, of course, for other people who struggle with it. And the change of character is, let's say, previously known as a reversal. That's it. It only highlights a reversal. If you come from ICT or from other training mentors, they call it differently. I learned it as reversal type 1, reversal type 2. And here we nowadays call it CHoCH. For me, it's pretty obvious and clear what a CHoCH is. And it goes in line with a shift in structure, or you call it a boss, a twin boss, whatever. And why, you will see here, because you have a break of structure, a bullish break of structure, another bullish break of structure, and all of a sudden you have a bullish break of structure followed by a bearish break of structure. And that's your CHoCH frame. Whenever you have this shift in structure, this is called a CHoCH, because you have a boss in one direction, a boss in the other direction. And again, this is fractal. It happens on all time frames. One thing I have to admit, and you can see it here for both examples, you have a higher time frame point of interest or an order block, a higher time frame point of interest or order block here as well. You have a bullish trend, and suddenly you have a CHoCH. And what is the CHoCH? You have a boss, a bullish boss followed by a bearish boss. And this indicates that the structure will shift. And you will have a lot of CHoCHs in all of the swing points here. If you go down to lower time frames, you will see CHoCHs everywhere. And that's what makes it very important to concentrate on your higher time frame point of interests, because this is where you want to consider the CHoCHs. You don't want to consider them everywhere unless you are a scalper. And if you're a scalper, then the swing points probably are your higher time frame point of interest. But in this example, it could be the 4-hour point of interest or order block. And you want to see the structure on 15 minutes, and you can see 15 minutes structure shifted. And now you have been waiting for a bearish sign. This is your bearish sign now, and this is the order block you would be concentrating on. But also, again, this is now only the explanation for a CHoCH. The video will be available later on. I know I'm going through pretty fast, but the video is available. You can have a look at it again. And of course, the questions you have, just raise them in the group. We will talk about it. But I hopefully I could explain it in a way that you get it. All a CHoCH is a reversal. And now that we already introduced the point of interest, we of course also talk about the point of interest. And what is it? Well, it can be a lot of things actually. The point of interest can be a higher time frame order block. It can be a higher time frame imbalance. It can be a higher time frame swing point. But one thing you have to understand is the point of interest is a zone which you mark according to your strategy, which you want to monitor. And it's a zone rather than a point, to be honest. But it's somehow a zone where you set an alert which you want to monitor, and when the price comes back to this zone, you're looking for something. And in our case, what we usually do is we have a kind of, like it's highlighted here, we have a kind of order block, which we say is our point of interest. The price was bullish. We had bullish intentions. So we waited we knew the price would go up, and it left imbalance, it left an order block. We marked this order block as our point of interest, which is in fact a zone, on the 4 hour, on the 1 hour, whatever. And when the price comes back, we now monitor this zone for a CHoCH, for a reversal, because the reversal would be an indication that the price wants to go higher from here again. That's all we do. Sometimes, of course, the zone is just broken, but very often it's just respected, and the respect of this zone is shown with a CHoCH on a lower time frame, as you can see here. And if you had this CHoCH, you have another new point or zone of interest, which might be your 5 minutes order block, which you wait for, and you might then be able to even have a higher risk to reward by only trading this one instead of trading directly this zone. But again, these are topics which might be handled in different sessions, because there's too much details for that. I just want to highlight once again that the point of interest is not necessarily an order block. It can be, but it can be so many other things, like a supply or demand zone, which is usually also an order block, but it has a different name. But it can also be other topics. It just describes a zone of interest for you. And then we have the imbalance. So let's talk about the imbalance. What is it actually? Well, to make it very simple, you would say an imbalance is if the price moves only in one direction. And why is this? For example, you have a point of interest or an order block. The price moves away from this order block only in one direction. And this would actually describe on a very high level an imbalance. Now, you can see this by this price moving away, you have areas which are balanced, like this one. And why are they balanced? Because for all the buys, you also have sells. This is what you can see here. In this area, you had buys, which are balanced by sells. So you consider this area as balanced, and it's the same for this. Starting from here, the buys are covered with sells. So you consider this one balanced. So you would also see the kind of consolidation zones and so on is balanced. But what is now imbalance? It's actually what's left. Sorry, what's left is the zones which only moved in one direction, which is this one. From here to here, until you had this new low, there's an imbalance. You only have buys. Same for here. From here to here until this low, you only have the price moving in one direction. That's an imbalance. And the third imbalance here. And those imbalances are very strong because the price or market makers tend to move the price back to this imbalanced zones in order to kind of mitigate. We will talk about this as well later on, but to have a balanced, to have a balanced price action, to say it that way. In order to buy something, you have to have somebody who sells something. And if you buy, there is somebody on the other side who sells to you. Otherwise, you would not be able to buy it. It's the same thing as if you go to the shop. In order that you can buy anything there, they have to sell you something. And it's the same here, and vice versa. In order that you can sell again something, you have to find somebody who buys it from you. And that's what's happening here. And if there is only buys but no sells, then there is some kinds of imbalance. And sometimes when the market makers move the price away from a zone only in one direction, they make a big loss. And in order to mitigate the loss, they just have to come back and balance out again, just to drive the price higher. But there's really not much prosa, I know this, but that's because if you Google imbalance, you can read a lot about it. It's a very interesting topic. It's a strong topic, And again, you can cover only one session alone with imbalance. And now we have a chart example here. Now we have a chart example here from where you can see an imbalance where the candle, the price, at least on this time frame, only moved in one direction, which is a clear imbalance, and then a balance state where the price had to come back and it balanced the price to the pip, so that for this price action, it was fine to just move up. It did not, this price, unfortunately, from space point of view, I didn't cover the further price action, but the price did not come back to this order block. It also did not come back to this order block. It just mitigated the imbalance and then moved up again. And anyways, you could see here that the order block was mitigated already and this order block was mitigated already. It does not mean that it cannot be revisited again. That's not the case. It just says that this one would not be considered fresh. This one would not be considered fresh anymore, and hence it's not as strong as a fresh one. But also for this one, we will have more example later on. And depending again, like with the BOSS and the BMS, where you're coming from, the imbalance is also called a fair value gap, because this is a gap in price which is not considered a fair price anymore, because the price only moved in this one direction. And once it comes back to reclaim all the orders, it's considered a fair value, and then it can move up again. I'm pretty sure you already saw this from Kyle's explanations and examples, which are very, very good. And you will see them more often. And I hope it starts to make a little bit more sense now. If somebody says, here is an imbalance, have a look at it and you know what's meant with an imbalance. And now we go on to the mitigations. I know I already took the phrase mitigations a lot of time, although I haven't explained it. I'm very sorry for that. I tried to make my mind up what order might be the best one in order to explain all the phrases. However, now it's too late anyways. We are at mitigations. And you can see here, we have an unmitigated order block. And I just consider for the moment, you know what order blocks roughly are, because that's all our whole coaching at the moment is based on. So this is an unmitigated order block. Why is it unmitigated? Because the price moved away in one direction and it never came back to revisit it or reclaim it. That's how it's sometimes called. And this means it's not mitigated. And if price would come back, yeah, maybe first this one, you can see while price is moving away, it creates internal structure. And this internal structure creates new unmitigated order blocks. So you had a point of interest, which was a higher time frame order block where price reacted and moved away. And while it was moving away, it created internal structure and it left new order blocks which broke structure by themselves on lower time frame. And all of them have not been revisited. You know, this order block broke structure, created a new high, price never came back. So it's not mitigated. It was not revisited. So it's considered a fresh and strong order block. Same with this one. Price came down a little bit, but broke the new high, broke structure, left a new unmitigated order block. Why? Because price never came back to revisit it and to reclaim all the orders in this order block. And now we have exactly the situation we are looking for. First order block was in this case. So there's a lot of scenarios when it comes for this one, but in this case, it was mitigated first. It was visited. There was a first reaction and then it was broken. And this is actually what you also consider a supply zone, where you have a point of interaction like this one, point of reaction, then the price was moved a little bit higher, and then the supply zone was, sorry, this one is not a supply zone, this is a demand zone. You had a point of reaction on the demand zone, price wanted to go higher, was not able to break the new high, this demand zone was broken, and the order block was mitigated. That's not fresh, it's not considered anymore because it was completely broken. Then it came back to the next fresh order block, which was not revisited before, and now it's considered, because it was revisited by price, now it's considered mitigated. And I did not draw anything from here. The price could now, you know, break the new highs and so on. It could go through it. However, it's not about what price does now. It's what it's about mitigated or unmitigated order blocks. Price came back. This order block is not fresh anymore. It's not considered fresh. It's mitigated. So that's all we mean when we say order block was mitigated. You can compare to the order block is not fresh anymore. And again, of course, the price could go up, revisit again, go up, revisit again, and then go up. You never know how many orders are waiting in this order block. I will give you more details again about this one later on, what an order block actually is and why it works the way it works. It's just the probability which is lowered once it's visited already. And then we have the liquidity. We're also talking a lot of times about liquidity. And I think it's also one of the main topics of Kyle, and he explains it very well as well. But for newbies, it can be difficult to understand. It was difficult for me as well. And it's not always very objective. That's the problem. Because once you know what liquidity is, sometimes, let's say, at first you are completely confused by liquidity. Then, if you step over this, you see liquidity everywhere suddenly, which is confusing you again because you're afraid to do anything. Everywhere is liquidity. The price could go everywhere. And once you understood when you have to consider liquidity concepts, everything will get easier. And I draw this liquidity as dollar signs because this is what most traders do, which I follow, is they draw the liquidity as dollar signs as long as it's fresh. So the liquidity has not been taken. You see the dollar signs, and this means there is liquidity waiting. And there's a lot of liquidity scenarios and concepts. I just want to talk about 3 main concepts because they should cover the main topics, in fact. And again, there's a lot more about it, but here we have a clear uptrend, which you can see. And in this uptrend, it could be internal structure, it could be swing structure, it doesn't matter, but usually it's used with internal structure. You have kind of trend line liquidity. That's what it's called here. And why is this considered trend line liquidity? Because there's a lot of trend line traders out there. And whenever a new low is created, they would put their stops exactly below these lows. And hence, everywhere below these lows, there is waiting liquidity and money. And then we have equal high liquidity and equal low liquidity. And then, of course, there's also something similar like relatively equal high, relatively equal low is when they are not exactly at the same position, but one is a little bit higher, a little bit lower. That's still considered a liquidity, but you have to see which one is higher than the other. Yeah, I think that's the next step we should explain. You can see here the highlighted areas. This is where the stops, you know, from buyers are waiting because they want to protect their buys here below the lows. And I think all of us do it that way, at least have learned it that way. And hence there's a lot of money waiting below all of this. And money is liquidity, and liquidity is needed for the market maker to move the price. And it's the same with the equal highs and equal lows. Traders would sell here for, depending on your trading style, of course, but traders would sell here because they might consider this being resistant. The price was not able to break this line, goes up again, was not able to break this line. Oh, that's a very strong resistance, goes up again. But all it actually wanted to do is to engineer and build liquidity, because there's algorithms behind, there's market makers who do this on purpose because they know what we as retail traders do, and how we trade. And of course, they have other tools where they can have a look how many orders are waiting here, and what's the best direction to move the price to. In fact, oops, is this admit? And it's the same for the equal lows and relatively equal lows. It's engineered liquidity. Now, I don't have for the moment chart examples. It's just for you to understand when we talk about liquidity, what do we mean with it? And if you have a look on Kyle's examples, you will see the liquidity he points out everywhere. And now you should know what he means with liquidity, because this is exactly what usually happens. For the trend line liquidity and the X usually in the charts, the marked up charts, they indicate liquidity has been taken. Liquidity has been taken, and here as well, liquidity has been taken. What does that mean? You had an uptrend, internal structure maybe, and you had the stops here, you had the stops here. Price suddenly moves lower, breaks this internal low, only to take liquidity, which is waiting here, the money which is waiting here, to move the price higher afterwards, to create a new high. And it's the same here. Equal highs, equal lows. They moved it usually to the pip. Sometimes the second one is a little bit lower, which even provides more liquidity, because people think that they have a confirmed entry. This low is lower than this one just by a few pips. So of course we have now a downtrend, and this means even more liquidity. If this one would be higher, it actually would have taken out already this liquidity. So if this one is lower, or at least both have the same height, then you can consider there is a lot of liquidity sitting above it, and the price might go up just with a few pips to take out liquidity, usually with a wick only, to be honest, and then make a breaker structure. And that's, by the way, is something, if you see that the price takes out liquidity like here, and then as a next step, break structure, this is now a strong zone you want to have a look at. Liquidity, breaking structure, this is the zone you want to have a look now. Because they took liquidity, they have no interest in going back up here again. They drove the price in one direction, they don't want to go up again usually. And this high is now really considered a protected high, because they don't want to break this once more. Everybody here was trapped, taken out, and now, because it's not only sell stops waiting here, or stop losses for sales waiting here, it's also buy stops waiting here for people who consider breakout trading. And those buy stops are now trapped because they triggered it and then they moved away. And it's the same concept here. Yeah, and then there is a saying, don't be the liquidity. So if you understand the concept, because usually we are very often liquidity, because we put our stops where market makers and banks want to have the stops, and hence we are very often liquidity. So you should try to prevent to be the liquidity, don't be the liquidity. And then we have the inducement, which is another new, or not new, nice SMC word. And I think now in this case, there might be different concepts. How I understand inducement is it's a liquidity trap, saying the price or market makers engineer liquidity only to trap you and to take it out. And there's certain situations in when price moves where you can actually see that this exactly happens, and you wait for it to confirm that this is the trade you want to have. We had this example already quite often now. You have point of interest, price moves away, and then you have the equal lows, kind of, you know, the last low is a little bit higher, which confirms, you know, you might be on the right side, only to engineer liquidity here as well, because they want to, if I say they, I mean the banks and market makers, they want to drive price higher. And what they do is they trap you with this, saying, okay, come on, jump in, the trend is your friend, put your buy orders here, and the stops of us are resting exactly below these lows, and hence you have the liquidity, the money here. And what happens next is, you will see this very often, price drives lower, and all this area here is the liquidity they take out with this move down, because there might be a lot of more buyers, you know, re-entries on lower time frames and so on. They take out the liquidity, they trapped you with this equal lows, just to have enough money, enough liquidity, enough fuel to move the price higher now. And that's actually considered a liquidity trap. If you already know price should go higher, but they engineer those lows for you only to take them out and to go higher. And that's what's meant with liquidity, with inducement. And now we come to the topic order block. I know most of you already know what order blocks are, some of you might not. And I always try to have explain everything in a way that even people who don't trade understand things. And I also try to do this with the order block. So what you see now, maybe you haven't seen so far. But what is an order block? It is a block of orders. We all know by now the main order blocks we are concentrate on is engulfings. So it's an engulfing pattern. We can see we had a down move, and then there was an up move which engulfed the down move. Hence, there must be something in this area that moved the price higher. And usually this is orders waiting there, or which have been waiting there for a long time, which have been put by the banks and the market makers there to move the price from this point on now higher. And what you can see here is that the order block is, you know, the price moved away from the order block, it comes back and mitigates it a little bit, let's say it that way. And if you consider this internal structures, of course, there's a lot of order blocks as well, smaller ones, but this is, let's stay with this order block. And now it comes back and it collects new orders which have been waiting in this block. And these orders have been enough to move price away. Let's say higher in this case. But it was not enough to move it away in order to break this high. So it had to come back because the orders waiting here were stronger and move the price lower and deeper into the order block. So it collected several new orders until the price was again strong enough now to break this high and this high. And that's the reason why, if a price comes back to order block and it was mitigated to 50%, it means orders which have been waiting here were enough to move the price. Sometimes it's not enough. It has to go deeper, and there's a lot of more orders waiting. One thing we know is that you cannot have one block sitting here with all the orders you need to move the price. That's not possible for the banks. They have to split their orders, and that's why you see these price movements. And this order block is now mitigated and enough to move the price. Now, sometimes, maybe, you know, hours, days, weeks later, the price comes back and also probably collects these orders, but those orders which are left here are not strong enough to send the price away again. It probably just has a short reaction and then break through it because there was not enough orders left. But sometimes A few orders are enough, which are on the first layers to move price away. And that's why you see that an order block can be claimed more often until it's completely out of orders, let's say it that way. And then I wanted to talk about order blocks itself. The order blocks we are at the moment looking at in Anne's channel are mainly the engulfing ones, which is the most obvious order block you can have. Again, here you have an up move, which is then followed by a down move, and which is engulfing the whole move up. And yeah, that's an engulfing pattern as we know it. There's different explanations on engulfing patterns itself, but you can look that up on yourself if you want to. For us, that's enough. All we need to know is this one. You have this, we call this afterwards as the order block because price moved away, and we expect that there must be orders sitting in this block here because it sent the price lower in this case. Now, what a lot of people, not a lot of people, maybe only in the group, did not recognize so far is that there is an order block in the wicks as well. Not in all the wicks. You have to have a look at the full candle, of course. If this would be a buy candle, I would not consider it being a bearish order block, but it's a sell candle with a large wick, and there is an order block waiting in the wick. So this is something you can consider if you have a look at order blocks. And why is this the case, that there is an bearish order block in this case in the wick? Because all you have is a buy to sell situation. Price goes up, then goes down. And that's exactly the same what you have here. Price goes up and then goes down. And this one here, if you get this candle with the wick on a 30 minutes time frame, on a 15 minutes you might see this one. Because on a 15 minutes you have two candles, on a 13 minutes you have one candle, and this one candle combined is this obvious engulfing pattern. So have a look at the engulfings and have a look especially on this. And for a, what did we have? A bearish, for a bullish order block, we would have it the other way around, of course. You have a wick to the downside with a blue body on the top. And then I also wanted to talk about other kinds of order blocks, which you might have recognized already, but didn't use so far, which is the doji candle, for example. And why is a doji candle, or why could a doji candle be also a order block? Because it can be, it usually on a lower time frame is a consolidation zone. So if you have this candle, let's say on the daily, then the whole day could actually only be a consolidation. Price moved up, down, up, down, up, down, up, down, the whole day. And for the day, you would only see this as consolidation zone. And after this consolidation zone, you usually have a breakout. And if the price breaks out to one side, the whole consolidation zone has an order block. If it breaks out to the upside, usually you have an order block around here. If it breaks out to the downside, you usually have an order block here. It's not easy to say at the moment, but you have to have a look at the price where the order block is sitting, or where there is obvious order blocks. And it can also be supply and demand flip zones. But one thing you will recognize as you analyze the charts is that doji candles with big wicks are very strong zones as well. And then we have the inside bar, which is actually similar to what I just said before with the consolidation zones, because inside bars on lower time frames can also be consolidation zones and contraction zones. But usually, to my experience, they are a kind of SMC market cycle. What you have here is you can see the contraction here, and then you have a breakout of this zone with an order block waiting here. So you have a consolidation, then you have a breakout. I'm not talking about a wick breakout. I'm talking about a big obvious breakout where you can see the market maker footsteps. they had to use a lot of money to move the price now lower to break out of this zone, but then they had to come back to this order block to move it again outside of this zone. But I think the SMC market cycle is such an important topic that we should cover it, of course, in an own session. It's a strong strategy by itself, to be honest. So all I want to say here, an inside bar could easily be SMC market cycle on a lower time frame, and it's a strong zone which you can mark up as an order block. You can consider it as an order block. And something I want to point out is also that an order block alone doesn't say much. You know, you have order blocks everywhere. If you have a look at the charts, in order to trade an order block, there has to be a lot more around it. And for me, an engulfing candle pattern is an engulfing candle pattern only. I don't consider every engulfing as an order block. But if this engulfing pattern broke structure, or let's say took liquidity, broke structure and left imbalance, then this pattern all of a sudden is a valid order block for me, because it did what it should do in order to get to become interesting for me. And of course, then we have, it should not have been mitigated. Why not? Because then we consider it as fresh and strong. And if it created inducement, even better. So then I had a few examples here, which is, this is how I usually mark up my my charts. And I think this was a very nice example, which covers everything. You had the price here moving down, and you had a kind of engulfing pattern here, but you can see here, this is actually not an engulfing, this one is a doji. And usually what I would do here is I would mark up the whole zone, the whole doji, because you never know. However, what I could see here is before this move away from this last buy candle, this move away from this last buy candle happened, it took out equal highs, like you can see here, which means this order block took liquidity and then moved away to break structure. And what it also did was it left imbalance here. You can see here, from here to here, it only moved in one direction. And you can consider this as inducement, a kind of new low it created only to take it out later. So you have a fresh order block, you have imbalance, you have inducement. It took liquidity, it moved away strong, as you can see. So when it comes back, you highlight what I do. I consider this as the full swing zone. So I mark it up as my swing. Then I mark up what's premium, what's discount, what's equilibrium, which is 50% of this zone is equilibrium. Everything above is premium price, everything below is discount price. And then I'm looking for an order block or a strong point of interest, which is this one, which has everything I'm looking for in the premium zone, if it's in a downtrend, or in a discount zone, if it's for an uptrend. And obviously here, with all our markups, we have a very strong order block in the premium zone, which we are interested in. And if we have our order block checklist, we can go through it and say, is this something we are interested in? We are in a downtrend. Order block took liquidity. Yes, it did. And this is obvious liquidity because it's two same highs. Order block broke structure. Well, it didn't manage to broke it with the first move. So you have a kind of zone which has been created here. This could look completely different, but on a lower time frame, it looks more obvious, I'm pretty sure. So it didn't manage to break this structure with the first move. However, it broke structure finally. And then this is considered as, yes, this order block broke structure. You could also say this order block broke structure because there's a new order block created, which had a reaction on the right side. Everything fine so far, but it's not within the premium zone. It's already in the discount zone. So for me, I would not even see this because I'm only interested in the premium zone. The order block left imbalance, yes, we talked about it, left imbalance. Order block was not mitigated. As I drew this zone here, the order block was not mitigated. And the order block created inducement. And this is, for me, it's not the most obvious inducement, but for me it is. So everything is fine for me, where I even would have a direct entry. And now you can see all the words we use: imbalance, mitigation, inducement, liquidity. Now everything should start to make more sense when you have a look at the whole price chart. I also wanted to just draw a theoretical situation where you have, you have a swing zone. This is what you should concentrate on. You have a swing zone from a low to a high, which the whole swing zone broke structure in the past, which is this one, swing zone that broke structure. This is the first thing you have a look at. And then you would have a look at, did it start from a POI, for example, a 4-hour? What kind of order blocks did it create? And you go through the checklist again. Did it take liquidity? We don't know because we don't see it here in the past, and it's theoretical. Did it break structure? Yes, it did. It broke this swing structure here. Did it left imbalance? Yes, it moved away only, did not come back. It left imbalance. Was it mitigated? No, when we draw the line, the zone here to the high, the order block was not mitigated. Did it create inducement? Yes, I would consider this one as inducement, so everything is fine for me. And what I also do when I do this kind of chart analysis is I draw the Fibonacci and the SMC zone next to my swing zone, because everything below 50% here is the discount zone. And for an up move or for a buy entry, I want to have the price coming back exactly, not exactly, somewhere to this zone. It needs to be for sure below the equilibrium, below the 50%, but even better, if there's order blocks resting around here, I'm interested in those order blocks. And I'm also interested in the extreme order blocks. Because remember, as this low broke this high, we consider this one as protected. So next one. Yeah, this is another chart example. It's the final one, I think. You have a swing zone from a low to a high, and this swing broke structure here. And then I'm again mark up the FIB, let's say the SMC zone. I'm looking for order blocks in the SMC zone and at the extreme, which would this one would be as well a valid order block. This one here, you can see the wick would be also one probably, but it's been mitigated and broken anyway, so I would go for this and that. We have one order block which is below equilibrium, next to this zone, which I'm interested in. I would mark it up, and you can see here, price comes back, mitigates this order block here, goes a little bit lower than this candle, and then breaks structure again. And if we have our checklist, we would go again and say, did the order block take out liquidity? In this case, it's not very obvious, and it's not very strong maybe, but you can see this order block on the, we would have to have a look on the lower time frame, took out this low as well. This is not considered a strong liquidity takeout. I'm just saying here for this order block, we could say, yeah, it went lower, took out the liquidity below this one, just to afterwards break it again and move higher. So this is fine. We don't see the reaction here if this would be a protected low, because we don't see in the past. But we would go on for the next one. We said, did this one break structure? And yes, it broke structure, exactly this one. It went higher. Did it leave imbalance? Yeah, it left imbalance, not too much, but a little bit. Was it mitigated? No, at this point it wasn't mitigated. Did it create inducement? You can consider this one again as inducement because you already consider price will come lower than this one. This barely touched equilibrium. You consider that your entry will be lower. Hence, you can also say this could be your engineered inducement. And everything is actually fine so far. You don't always have to have all of them to consider a trade or an order block, but if all of them are there, you would consider this as a very strong point of interest, and you might want to trade it. And you should have a kind of checklist for yourself, because at first you concentrate on all of those topics. You will view the chart differently from that point on. And of course, it will help you. In this case, it was a successful example. It's not always the case, as we know anyways. All right, and this was it for the SMC topics I highlighted. There's a lot of you still here, so it tells me it was not too boring, hopefully, and I hope I could bring the topics to you a little bit and make it more clear than they were before. I just repeat myself for the people who attended late. I know that all of those topics can be covered in several sessions by itself. It was just to bring you the topics closer, because we often talk about them. You will see them more often in the chart markups, because that's exactly what Smart Money Concept, or SMC, is about. You want to learn how the price moves. You want to read the charts in SMC style. That's all we want to provide you and to give you. And yeah, I just want to take the chance. We will have in future also the possibility for one-on-one sessions. I think it will be Kyle and it will be myself. And if you're interested in, yeah, this is something what we will offer in future. Anyways, all the questions I try to cover after we have uploaded the videos. I will go through them in order to see what questions are left. Some of them might already have been answered, and a few are open for sure, and they might be interested to all of the others as well. So it makes sense to answer them in the web spaces which we have, and we all can again learn from it. And it for sure has raised a lot of new questions now. With every new topic I provided here, there's a lot of new questions, and this will help us also to see where you struggle, what you want to learn in future, and where we have to put our focus on, to be honest. And I'm 8 minutes over the time. I would not actually now answer the questions on the video. I hope you are not disappointed with that, but I will answer your questions for sure. You can rely on that. And I want to say thank you to everybody that you attended. I'm having a lot of fun with you together also in the group. There's a lot of nice ladies and gentlemen, and I'm looking forward to work with you.
Hey, Marcus. This is Anne. Can you hear me?
Yeah, of course. Yeah. Hey, Anne.
All right. Hi. Oh my God, it's so good. It's very clear, wonderful presentation. So I just want to say to everyone that Marcus has become StarseedFX coach official. So later on, he will hold like a not really weekly Zoom call, but at least like once a month or probably twice a month. We don't know. And he's also become a moderator. And plus, so as a part of the StarseedFX service that we are going to offering one-on-one with Marcus, there will be a fee, of course, but it will go 100% to Marcus to appreciate his time. And if you want to understand more and in details related to what he's teaching and really like the way he's teaching, you can go ahead, book one-on-one with him at any time. And as a member of StarseedFX, you will get a huge discount. As you know that it can cost you probably in the thousands of dollars outside if you want to get one-on-one. So what he's gonna do is that he will focus on what you need, what you really want to master. So he's not going to teach you this and that, or which probably you already know. So you will discuss with him what is your need and everything, what you want to master is exactly the same, just like my free one-on-one, which is that is aside from the Starseed FX. I'm just doing it like for the sake of well, I can say it like for fun for those who are lucky. But obviously we have to appreciate his time and his dedication in helping other people. So you go ahead, discuss with him, and I will tell you the price will be less than $100 for one-on-one session. You don't want to miss it. So you go ahead, contact him. Marcus, can they contact you via they already know, right? What is your Telegram ID? Maybe for those who don't know your Telegram ID here, so they can contact you and get one-on-one. So especially for Starseed FX member, you can get one-on-one access with Marcus with a very big discount from him. All right, so I would suggest try, when it comes to one-on-one session, sometimes it will not be enough if it is only for one session. So I would suggest at least to get like 2 to 3 sessions with him. This is really important, because sometimes we need someone to encourage us, someone who will give you homework, who will monitor and then evaluate. When you have someone beside you to do that, that will be amazing, right? So I guess that's it from me. Just a little announcement that Marcus is our StarseedFX official coach, and I'm so glad he's on board. Thank you so much, Marcus, for sharing your knowledge and all about this. This is truly amazing. All right, guys, that is all from me. And Marcus, you can take over. Thank you. Bye-bye.
Yeah, thank you, Anne. I will take over one more time. Yeah, as Anne said, I'm very happy that she gave the opportunity to me. I always was looking for such a simple concept as Anne and her husband provide. To be honest, I'm amazed by what they are providing to you already. And as I said in the beginning, my goal is to even more simplify things. That's what drives me personally. I want to find things where I can simplify things even more. And I'm very happy that Anne provided me the chance. And what Anne also will do is she will provide some kind of coaching areas in the web space. And I think it would make sense if you would actually contact me there, because then we have a consolidated area. Of course, you can also contact me with Telegram. My ID is visible. If you click on the group, you can see the ID of everybody. You can also contact me there, as a lot of other people do. Like it's if you want to know it right now, it's MMB Invest. That's my ID on Telegram. But we have the web space where all of us have access, and where we anyways can contact each of us whenever we want. And I like it, what Anne has set up. It was a lot of effort for sure, and we of course can use it, that it makes sense as well. And again, I just can say thank you to you all. It was a pleasure, and I'm really looking forward to have more sessions with you. And we have prepared a lot of more things to come, only those I know, which is for one-on-one sessions, of course, that you, for example, have also to prepare a little bit before. There's a few rules which you have to take care about, that we can provide you the best experience ever. And because we just don't want to spend our time, we want to be a benefit to you. We want to be a value added. That's the goal. And that's one goal we all share. I think Anne, no doubt, Kyle and myself, to bring all those topics to you. And we know it's not easy, but we try to make it as easy as possible. So thank you again. I will stop the recording now. And as soon as the video is uploaded, we have the questions available, we go for the questions. Thank you